I got his charts up with the counter.
Okay, everybody. Welcome, welcome, welcome. We just got to go through these important disclosures one quick time. So let's just give you a couple seconds on the first page where it says, let's go. Make sure I got you posted up here, important disclosures. We're still waiting for a few people to come in, so I'm just going to give it a couple extra seconds. Second page of disclosures. And here's the third page of disclosures.
I'll show about 8 days history.
And here's the fourth page of disclosures, and then we'll get moving on to today's show. We're also getting all set up here in the background, so that's the background noise. But you guys will be good in 1 second. All right, Ben, I'm going to turn this off, okay?
No.
Okay, minimize.
Switch it. No. Day trading.
Okay, perfect.
No.
Oh, you got a nice little...
You want to start with we will. Yeah,
All right, everybody. Thanks. This presentation today, by the way, because somebody just asked in the Trader Lounge, this presentation will be archived. We're allowed to archive guest speakers, and Linda Raschke is one of the most popular in the whole world, I think. Anyway, it will be archived, so we're excited about it. So anyway, my name is Tom Sosnoff. I'm happy to be here today. And so I was away for a couple of days. I just got back into town, and I was on a beach in Cabo or something, and I just got back. What's going on? Just kidding. I've been here. And I just wanted to give a couple of... as you can see today, we switched back to the red Thinkorswim logo, and market went up, bonds went down, system was fine. So maybe that was it. I don't know, but just kidding a little bit. Kind of a rough 2 days for us technology-wise. It's been 10 years since we ever rolled our platform back on a new release. We've made 1,700 releases over a 10-year period, and we've never had a single rollback until this week. So I guess it happens. Maybe we're entitled to one. We found our bugs. We fixed our platform. We'll push out the release probably in about 10 days. We just want to check everything 75 million more times over, and then you should have back to all the new efficiencies and a lightning fast platform. Hopefully today went okay, except for saving studies. Anything that was saved on version 17.14 will be back into production when we upgrade to 17.14 in about 10 days. Right now we're running on version 16.78. Just as kind of an update to kind of now that I know what happened, we pushed out a release on Saturday morning. It went kind of as planned. Everything seemed normal. We checked the release all weekend. It's hard for us to check things in production. You really can't simulate, 50,000 users banging on your system. You can simulate traffic and all that kind of stuff, but you can't simulate all the users until you get into production. We were fine Sunday night. We were fine on the opening Monday morning, and then we saw a huge spike in our data traffic over the next couple of hours. And although the system remained up and all the orders in the system were slow, we stayed up the whole time for 2 days, but we had some issues with slowness, and we couldn't figure out where the bug was. Once we rolled back last night, we found all the problems, which just had to do with different permissioning to certain quote streams that were kind of flooding the system. There was too much outbound traffic, and it just wasn't allowing us to process all the data, which was slowing up the system. It's all been corrected. It's all been fixed. As you saw today, it was a very quick day on the platform. Kind of an unbelievable market today, too. If you take a look at S&Ps, I can't remember. Let me turn on Linda here.
I still have some few brain cells left after today.
Do you, after today?
Yeah.
So when was the last time we saw a 33-point update? And you got to talk right into that mic.
Actually, just if you remember how we came off that July lows, we had an even bigger update.
Was it bigger than 30? Because I couldn't. I was just talking.
I think we were close to 45 points up that
You're right.
day,
You're
yeah.
right. But up about, I think it was about 58 points in the NASDAQ today, up about 33 points in the S&Ps, up a nice size move in the euro versus the U.S. dollar. And at one point today, we had bonds down about 210, 211, and then they closed down about 120. So just kind of this pretty powerful day out there today. End of a slow week, kind of thin markets going into a long holiday weekend. I mean, I think we've seen it before, but I don't think that I think we've seen it before, but I'm not sure that anybody expected this off of kind of yesterday's action.
You had a tremendously strong GDP number last night out of Australia, which was what sparked the rally, and that led to an upside breakout, first in the DAX out of that 6-day trading range it had, and then this was followed by the upside breakout in the S&P out of that 5 to 6 day coil we had made. So since we're all sleeping at night in theory these days and not trading the Australian and the European sessions, our topic today is going to deal with day trading. What do we do when we wake up and have our coffee and come in the morning? And trust me, I can give some illuminating statistics that will show you there's still plenty of party left in the U.S. session. So with that, we're going to jump into our topic of day trading minis.
You know what? That was the most professional lead-in I have ever heard. You start, and by the way, not all of us were sleeping last night. Some of us have been up for 48 straight hours. Okay, routing orders and checking systems. But for those of you that were happily and merrily sleeping last night, you know what? It was kind of funny because. I was up all night and I was watching the markets all night. They were choppy, but they were not. I mean, they were obviously up the whole night, up 10, up 12, up 13, up 18, then back to up 12. But it was kind of like this choppy, very thin night. But there was never a time when they looked ugly. I mean, there was never a time when they looked like they wanted to go down. And today was just really kind of an amazing rally. We can talk about all the stocks and stuff like that. But it is 3:30, and Linda is one of the guests you haven't been on here in a while, have you?
I think it's been a year and a half.
It's been a year and a half. Oh my God, we're getting older.
Due.
Oh my God.
Two more gray hairs, right?
Yeah. No, you are not gray.
I wasn't referring to me.
Oh, me? Yeah. So I'm going to turn the mic over to you. I don't want to spoil any of your time. There's a million people on here. There's a million people on here wanting to listen to Linda. I'm going to turn the mic over to you. Have a great session. You've got as much time. I promise everybody on here, she can stay as long as she wants. If you can keep her on here till about midnight, all power to you.
He's signing away my dinner time.
I'll buy dinner if you stay on till midnight.
Okay, deal.
And don't read the chats in here. They're going to scare you, okay?
I took my glasses off for that reason.
Okay, everybody, enjoy today's chat.
So I like this red logo, trade by colors. That sounds a lot easier than doing too much analysis on these indicators and so forth. You know, just as an aside, I mentioned that there was a while there where we were getting so much action in the overnight markets, people started questioning, the ranges that we'd have in our U.S. session here. And so we ran a lot of statistics and studies, and truly 65% of the 24-hour ranges, sometimes greater than that, more than 70% of the 24-hour range on balance is still coming in the U.S. session for these S&P contracts. So if you wake up and they're gapping up big, there's still plenty to play for. Now, at this time of the year, with that said, we're seeing a pattern continue that is very common in the summertime, and that is that the bulk of the action happens basically in the first 2 to 3 hours of trading. Now, if you're trading stocks and options, of course, you're waiting for that New York opening. We actually find a lot of activity an hour beforehand in the eminis. And then what happens is Europe closes. The Europeans are on holiday perpetually sometimes, but at least all through the month of August anyway. And of course, Japan's long closed, so the party pretty much dies after you get that European close, which comes in at 11:30 Eastern Standard Time. But with that said, let's focus on the fact that we're just going to analyze these E-mini markets just from the day session, the open of the New York Stock Exchange, opening bell, and that's what we can measure our stocks off. I'll go for a few stock tips at the end, as well as options. And, the first thing that I want to talk about today is getting some concepts straight, because I don't want to spend a lot of time on gobbledygook indicators other than just to show you a few little things with these E-minis, and an oscillator. But the first thing that you got to think about is that there's a lot of conceptual tools that we can use in our trading. For example, that first comment that I made about the European session ending at 12:30, and from what I understand these days, CNBC and the TVs are wise to this fact finally, after 6 months, that there is a tendency for the morning trend to end into that time period, which will fall just, 2 hours after the opening of the New York Exchange. So when I come in the morning, I've got a couple things that I've already got detailed out. I know the previous day's high and low. These are the most important pivot points, even on a day like today. But they'll be particularly important tomorrow to watch today's high tomorrow. So I'm always going to look at the previous day's high and low, and then I'm going to mark off my opening price. And if you wanted to, before the opening, you can always mark off the Globex highs and lows as well. But with this, it's going to tell us the trend for the day. You can have an up day, for example, that actually had a downtrend if in the advent you gapped up 25 handles and sold off 15. That would have been a downtrend off the opening price, even though it was still an up day. So for day trading purposes, the opening price is what we always use to monitor the degree of trend. If you have not had any familiarity with market profile concepts, which are just, there's about 2 or 3 main things that I can summarize up here for you. You certainly don't need to study the whole, theology of market profile out there, but it does have a lot of value in helping frame out action that frees us from being tied to 1 minute and 5 minute and 15-minute charts, which of course have validity too. But I came from the trading floor originally, as did Tom, and we didn't have charts, and so a lot of the tools, the professional trader that had a background before the screen, come to these things like time of day functionality, where did we open, how do we trade in the first hour, so forth, so forth. So I'm just going to show you 2 or 3 main tips here with charts. By the way, what the presentation little slideshow that you see up here now, it's got our website on there. There's all kinds of educational articles and tools where you can read more on this stuff. And if you have any burning questions which you think I can answer, I actually put up my personal email there for you, and I am happy to answer questions as long as it doesn't involve writing more than 3 pages. Okay, let's start off, and I just want to go and show you how important this opening price is. We're going to look at this before we start to discuss today's action, and today's action is a type of action that probably occurs maybe 8% of the time at most. So what I've got marked off here is, you can see this is the opening price. These dotted lines are the opening price of 3 days. And for a day trader, the main points to remember right off the bat is, if you like making counter trend trades, your best opportunities are going to come in the first hour of trading. Making counter trend trades in the afternoon session is a much weaker play. With that said, the one comment in looking for counter trend trades in the first hour is that you need to rule out those days like today, which is considered to be a classic trend day. So if we can work backwards in our logic there and say X, Y, Z are the signs to recognize a trend day. If trend day, then don't make counter trend trade. Hallelujah. We got a good part going for us right there. So in addition to the opening price, the other most important things are going to be the swing highs and the swing lows. I'm not a believer in Fibonacci and Gann and trader pivots and all this nonsense, because trust me, Paul Tudor Jones and Soros and the big boys and all those guys are not looking at this kind of stuff, you know. So maybe 0.1% of the population is looking at this stuff. I want to know where the most market participants are focusing their action on, and that's always going to be the previous highs and lows, because this is where the supply or the demand functions kick in. You know, buyers step in or sellers step in. Now, with that said, here's another common fallacy in technical analysis. If I have a single data point, like I do here on my left-hand side of the chart, that is not a support. Support is always defined by 2 data points or tests. Likewise, resistance is always going to be monitored by 2 data points, not just a single data point. So we'll look at that a little bit more in depth when we look at today's action and where we tested up to in the early AM session and then again in the afternoon. So with that said, I'm usually looking for to see if the market can find support around the previous day's lows or resistance around the previous day's highs. I'm just putting some crude conceptual things out there because you really need to have this before you start delving down into your framework of, you know, 1 or 5 minute or 15-minute bar charts, you know, with your fancy oscillators and so forth. So just simply put, on this first slide, on the day 1 opening, we had a pattern which is called open, drive, reject. Open, drive, reject. A fine book for you to read if you want to pursue these concepts in greater detail was written by Jim Dalton on Market Profile, and I'll get you the exact title of it, but if you just Googled Jim Dalton book, and it was his first book that he wrote, there you go. And there are 6 marvelous pages in this book. Don't worry about getting caught up in anything else, but 6 marvelous pages that describe the most common types of days that you'll have. For example, obviously a trend day would be one that opens at one end of the range and closes at the opposite end of the range. Today was a trend day, and that first open and then the open drive, the push out of that, quote, initial balance or that initial rotation around the opening price was so strong. So open drive is one type of sequence. Then you can have what we have here on the left-hand side of the chart, open, test, reject, and we came all the way back up, and then once we come back up to the opening price, that sets up a lot of interesting patterns. Opening price is really well watched. It can serve as an intraday resistance or support level. And you can see when we first rallied back up, what did we do? We tested the opening price on this day. This was about, 4, 5, 6 days ago on this first slide here. We tested down, came back up to the opening price, and everybody took their profits there. A little check back, at which point we blew above the opening price. Now, once you're above the opening price, just stay positive, positive, positive for the rest of the day. Same thing here on the next day. In the middle of the chart, we take our opening price. As I mentioned, it's very common to fluctuate in that first hour, have few counter trend trades, form that initial opening range, and then, of course, once we started breaking down below that, it was a steady pattern of lower lows and lower highs indicating a downtrend until you had a sell climax. Trends often end in a climax. Next day, open, quick little test, and then back up above the opening price. So forth, so forth. So the main things I wanted to point out early on is we're going to start off by writing down the opening price and looking for a sequence. Are we having early little bit of rotation? Maybe we trade 2 points up above the opening price, 2 points down below the opening price. price? Is it a strong open, form a little range, and then blast out of that range, which is very common after you have a gap, such as we had today. And then, of course, we have our days on much lighter volume where it's relatively trendless and we tend to fluctuate back and forth through the opening price the majority of the day. All concepts. Next slide, just to quickly summarize, watching the previous day's highs and lows. Each of these dotted lines that are vertical here represent one day, and I actually took a 30-minute candlestick chart here because I could show more instances. On the far left, we had pretty much a good drive off the opening price down and then fluctuated most of the day, forming a low. Next day, test below that low, and you can see how often we sit there and we test below the previous day's low. If we have a weak close, I'm going to look for the market to try and test or take out that low the next day. If we have a close at the upper end of our range, as we did here in the middle of the chart. Can everybody see this okay, by the way? It's... You can see then the next day we did test just a few ticks above that and come back down. At the lower end of the range, we closed weak. I want to see, how do we push below and trade around that low and so forth. Obviously, always most important in a trading range type of environment, which the market's really doing more than 50% of the time. Now, a lot of times, you say, how long do you look for it to fluctuate around the opening price? Just in general, normally we can have an hour of counter trend trading and so forth before the market tips its hand. If it's going to be a strong trend day, very often you don't trade any ticks below the opening price at all. In fact, that's one of the clues that we do have a strong trend day is if you gap and you don't see any trade below that opening price or vice versa above that opening price, for that first 30 minutes, there are ridiculously high odds that market is going to close on its opposite extreme. Now, of course, today when we opened, we did trade around the opening price a teeny bit, but we also did close at the opening end of our range. So we want to note, first off, if we open and immediately there's no real trades above or below that opening price, it is an incredibly strong indicator. I mean, just get on board, put in a stop on the opposite side of the opening price after the first 30 minutes, and you've got ridiculously high odds that you'll close at the opposite end of your range. So sometimes you can form a larger trading range and break in the last hour. That is possible. But I would encourage you, since I only have limited time here today, and there's so many other things that I want to cover, do get that book by Jim Dalton on the market profile concepts. It's so much more concise and easier to read than Peter Stottlemyre's original work. And again, it's been called the Day Trader's Bible by a lot of prop shops, so that in of itself should spark your interest there, just in detailing out the types of days that you can have. Okay, so I've emphasized my point. We got our opening price. Are we pushing outside of that opening range? Another good thing that's a really strong sign is volume. For example, today, I'll always pull up at the end of the first 30 minutes of trading a 30-minute chart of the New York Stock Exchange volume. And I'll get somebody to put up a chart here in the second half of our presentation of that for you. I think the symbol on the Thinkorswim platform is $TVOL. And just bring that up on a 30-minute chart and then compare today's first 30-minute range to the previous first 30-minute range. If it looks like it's a really strong first 30-minute bar, you're going to have heavy volume throughout the day. If it's a ridiculously light first 30-minute volume bar, odds are that you're going to continue to flounder around in a light volume trading range for the rest of the day. Unless, of course, it's an FOMC day. But that aside, that's what I'll look at after the first 30 minutes to confirm that we have an upside breakout. Another note, I know I'm trying to throw a lot of stuff at you all at once. Obviously, market internals will cover a little bit at the end, like the breadth and the tick and the VIX and so forth, because these are wonderful tools for the day trader. A lot of a day trader's job initially is looking for confirmation or non-confirmation, a basic principle of technical analysis. So let me give you some ways that we can look at confirmation or non-confirmation when we're trading and why this is so important. Number one, if we have confirmation, we're in a go with mode. That means it's a momentum market, or you can enter at the market, jump on board, the freight train's going, it's a yes, yes, it's a green light go type of environment. So confirmation can be used in several ways. We can use confirmation in looking for an oscillator to confirm the price. So if price is making new highs, we would want to see the oscillator making new highs. We can look at confirmation coming from an increase in volume. We obviously can look at confirmation across several indices, the Dow, the NASDAQ, the Russell, and the eminis, S&Ps. Another source of confirmation is if any of you ever look at the DAX contract that's traded on Eurex, I always look at that first thing in the morning because it kind of gives me a little preview of what's due to come for our market. So the DAX had the same 6-day trading range that our markets had. And if you remember that spike up that we had a couple days ago where the S&Ps first poked into that gap area, and again I'm referring to the pit session gap only, you had a case where the S&Ps poked up there, the Russell and the Dow, but the NASDAQ failed to take out that previous high. It failed to trade into that gap area. That was a sign of non-confirmation. So on our non-confirmation, we've got a fade trade, and that can be sell divergences on an oscillator. One index makes a new high, the other doesn't. You can play this game with stocks. Half the semiconductors make a new high, half of them don't, so forth and so forth. So that previous case, we had non-confirmation. On this push-up, the DAX had already taken out that key previous swing high, which you could see on a daily chart or even a 120-minute time frame. So, of course, all eyes then are watching on the S&Ps, and the cash market took it out first. It made new highs, and this was confirmed by an extremely high tick reading. Now, ticks are very correlated to the market breadth. So we had extremely strong breadth. Almost all the top 40 NYSE and the top 40 NASDAQ shares were plus on the day. Strong tick reading. So all signs saying that breakout this morning was confirmed to the upside. So I know I'm just like going a mile a minute here, but I know this is also going to be archived, and you can go back and review it. And lastly, I hope that you are all keeping a pad of paper in front of you and taking copious notes, because as an aside, if you write something down, it goes to a different part of your brain than if you are just listening to somebody talk or watching a screen. So in all your market studies, I encourage you constantly to keep a notebook. If you hear something, write it down. If you see something on the charts, write it down. If you read something, write it down. You don't even have to go back and read it. But the scientific studies show that process of writing it down has much higher memory retention than if you're just listening to me blab away. All right, let's go on and look at another chart. Now, we've got a basic framework for the day, and keep in mind at the end of this seminar, we're going to come back and put all these things into work for today's market, which was probably frustrating if you overslept and then had to sit there for that long, dull trading range in the middle of the day. But we've got our framework of open, high, low. Did the market trade high to low the previous day? Are we looking for a test to the low? Are we getting any morning reversals on the early tests? We know that if we do have a decent morning trend, pretty good odds it's going to carry up until that European close, which is at 11:30 Eastern Standard Time, 10:30 Chicago time, of course. Then we have what's called the dead zone, especially in the summertime. 2 hours of lethargic trading, dry up in volume, so forth and so forth. And then the party starts again in the afternoon, although I think everybody had a hangover today because that party was a little late in getting started. Now, I'll just tell you one more little cool thing that we just found in some of our testing and modeling. And I know that most of you, if you're trading even the stocks, you're watching the ticks. You know, the ticks have markup. When the programs come in, you'll have these nice plus 1,000 tick readings. And I love seeing new tick highs or ticks trading above the previous day's highs as a confirmation, like a momentum type of indicator. And on the strongest days, today, where we had extremely strong breadth reading, if you have extremely strong breadth reading and you get a minus tick reading, a good flush down, even new tick lows on the day, that's a fabulous buying opportunity. So I think that was one of the patterns that set up today. So with that said, we've got our time of day framework. We've got, and I was going on to these ticks. Okay, in this tick modeling, we modeled the ranges, for all the 5-minute bars and so forth. And we see when the highs and lows come in. And you have your strongest tick readings, believe it or not, after 2 p.m. Eastern Standard Time. So a lot of times in the morning session, if it's the first hour of trading, we used to play a game where S&Ps made new highs, but the ticks did not take out yesterday's highs as a non-confirmation game. But nowadays we're seeing, I don't know why, that the strongest tick readings to the upside and the downside do come in the last 2 hours of trading. So sometimes the best is yet to come, even though it may not have seemed like it today. Okay, we've touched on a little bit of market internals. Now let's just get down to the nitty-gritty here. I mentioned before, we're just going to do some basic technical analysis chart reading. Gee, that looks like my brain at the end of the day flashing there. It's stuck. Help. This is why I need a technical support person. Come on, talking about these technical glitches. It's life, it's life of a trader. I know Thinkorswim had their few challenges, but, ever since I can remember leaving the floor, these darn computers, they're just something that we have to live with. The internet, the technology, so forth. And, I firmly believe that we all need to hire an exorcist, like once a year, to come and wave the myrrh and incense and do an exorcism to get all these computer and technology gremlins out of our systems. Okay, let's go back to this particular chart of the eminis, which was yesterday, and I wanted to point out some cool things here that actually will work on any market, any time frame, but they're really adept here in the E-minis. And that is, we mentioned, first of all, that if you've been in a downtrend, you can see we were in a downtrend here, and we made this low. And then we had sort of this quasi-ABC up and tried to test that low. So now when you feel like there's been a test, at least you have support. However, support in and of itself does not constitute a trend reversal. Technically, for a trend reversal, you need to have 2 higher lows. This is classic Wyckoff. So you can see here, they can see me pointing this, right, on screen. We have our first low, a second higher low, or you could even call that a second higher low if you wanted. You can even call that, that's the first higher low, that's the second higher low, something like that. I spread it apart because at my age we get a little bit slower at recognizing these things, but you could have used 1, 2, 3 there. And you can draw a trend line, a rising trend line between 1, 2, 3 data points. Now you have technically the precursor to a true trend reversal, which is confirmed if you take out that last swing high. That is the process of a trend reversal. And a very slam dunk scalp trade is if you have this ABC type of pattern, which is a great trading pattern in and of itself. There's nothing to say that that couldn't have been similar to this at the left-hand side of the chart where you have this corrective ABC wave up. And of course, the oscillator looks all perfect there. But here we have ABC up. You can put a buy stop right above the high of that ABC to initiate a long, risk 6 ticks, and scalp out of it. So you could have done that right here at this point, or if you're a little bit slower, you've got 1, 2, 3 data points. We take out that ABC there, and we've got a confirmed uptrend. Now, only when you do a trend reversal does it justify trailing a stop. So here on the far right-hand side of the screen, I drew a little trend line for trailing a stop. And let me tell you a slam dunk way for trailing a stop, because there is no perfect way, first of all. If there was a perfect way to trail a stop, I would be like sitting out on an island drinking coconut drinks, okay? There is not a perfect way. But I can tell you the best way that I've come up with. And I say there's no perfect way because sometimes one method works better than another method and so forth. I simply use a 20-period EMA, exponential moving average, and I trail that stop a little bit beyond the moving average, not right at it, but about 1/3 of the way between the moving average. And here I have Keltner channels, which is a default function in the Thinkorswim platform. I set them 2.5, a factor of 2.5 ATRs, which is right there in your little setting change, away from this 20-period moving average. So you can see it would come right down here if I'm trailing a stop. Same thing here, right up here if I'm trailing a stop. Now, with that said, let me tell you first off that just because you're trailing a stop does not mean that you have to let that trail stop take you out of your trade. In fact, the majority of the times, if it's not a day like today, which was a trend day, you'll do better off using some discretion to exit when you start to feel like there's a test or some type of divergence or climax pattern. But the trail stop is there so you can still lock in profits along the way just in case that market reverses sharply on you. So in the long run, I don't feel like it's to your advantage if you're a day trader to simply trail stops. You trail a stop until you see an exit and can place an offer or sell on a little climax pattern, high tick reading, so forth, so forth. So that's my philosophy on that. So here you can see we have this trail stop function, but meanwhile we're still pushing through the Keltner channels and making pretty strong impulse to the upside. This actually includes a little bit of the night data. This big bar on the right-hand side of the chart was when the Australian GDP number came out, which was very bullish, and okay, everybody scramble and dogpile back into the markets. Now let's just look at a few more things. We talked about, okay, it's on the blank again. Do I need to click on it to calm it down? Okay. There we go. Okay. So I talked about that one trade where you're taking out the, the upside of that ABC. Now this time frame here on this chart is a higher tick time frame. I believe there's default functions in there, so this one's a little bit tighter data. And I've got a word about time frames to say in a minute. All I wanted to show here is let's just start with these ABC patterns as a central framework that you're trading around. Obviously, if you're in a downtrend and you get this corrective ABC type of wave up, especially when we can use our oscillators to confirm that, that's a choice trade, and I always like to think of that as a scalp trade. I'm looking for the push down. I'm looking for a spot to take profits. even though you very well easily could have trailed some type of stop and stayed with it. I probably would have looked to cover on a flush and then looked to reinitiate a short. By the way, as a day trader, I don't sit there and make more than 5 trades a day at most. Typically, I might make 2 to 4 trades a day. That's great for me as a day trader. Sometimes what happens is the more trades a person makes, the sloppier they get, the easier it is to get tripped up in the afternoon session. You'll see in general that there's 2, maybe 3 main turning points during the day. For example, today, I wouldn't count today because today was a trend day, but you might rally up in the morning session into that European time frame, exit, have a counter trend move over lunchtime or whatever. You have another inflection point and then perhaps rally up into the afternoon session. So you had 3 choice legs there, each leg lasting anywhere from 1 to 2 hours. And if you catch a piece of that, that's really a good part of the game on normal days. That's not talking about today's day. So no need to go in and out and in and out and in and out. If you do the math and you made 2 trades a day and you were able to be green on 3 out of 5 days, and let's say 3 days you made 3 points and 2 days you lost 2 points, I mean, you're still consistently ahead of the game, and that's not talking about catching, a nice 8-point move or 3-point move or a nice bigger win. Those are very realistic numbers, and I feel like you can actually do much better than that as you gain an experience. So the thing I want to look at in conjunction with the chart formation here, these ABCs, is the oscillator at the bottom. And now I've just simply put up a stochastic here, and I think it's a 9-period stochastic with a 16-period slow line, and that approximates the oscillator that I use, which I know is somewhere buried in this Thinkorswim platform or scripting language because somebody told me about it. So I'll let you bug those guys and find out where it is. But that's the 310 oscillator, which is the difference between a 3-period and a 10-period simple moving average, which makes a fast squiggly line very much like the red line on these charts, and then I run a 16-period moving average of that fast oscillator. Now, there's a real good trick here. Okay, what I've got on the screen is a stochastic, so the same trick works. But the 2 tricks. The first trick is that slow line is always going to be the fast line on a higher time frame. So let's say I had my moving average oscillator on a 5-minute chart. That the slow line on that, or the smooth line of the oscillator, is really going to be the fast line on a 15-minute. So the whole idea is that you have both time frames turning down together. And if we look at the left-hand example here on this, where I've got this ABC up, I wanted to point these red arrows to you here where the slow line is turning down. And that's what's so powerful, is that now that means that the higher time frame is kicking in as well. So I've got my counter trend correction here on this short time frame. The next time frame up, you got that oscillator turning down as well. And you can see here, same thing, ABC up, bam. Now here's the secret to day trading. A lot of times there's a lot of junk in the markets too. It's very much a patience game, waiting until you get your choice spot setting up. Here's another cool little trick. You can see in the middle of the chart here, we had a consolidation, a nice sideways line, and look at how you could draw trend lines on the oscillator showing a triangle. Anytime that you have any oscillator, it doesn't matter if it's a stochastic or a moving average oscillator, they're all a derivative of price. And you can draw a triangle on that oscillator. Bam! That's a great breakout trade, which is a whole different style of trading. So far, the main things in terms of chart structure we want to concentrate on are just simply looking for the corrective ABC waves in a downtrend. They are such a more powerful pattern than a simple flag, okay? Flags are nice, a simple little clean flag, but I love it when we get an ABC correction because you get a harder move down coming out of that. And then the false ABCs where you had an ABC, it tests down and then it takes out the high of that ABC. For example, on the left-hand side of this chart, if I did an ABC up here and I came down just to this data point and then reversed up, I could have a buy stop right above that level there to go long, and that looks like it sort of came in around 1061. So this is really a choice spot in the data here for reading charts, and these rules apply to any market and any time frame. Now the last thing I want to point out when you're looking at an oscillator is the cool way that they will also form channels that confirm the channels in the price. And for that, I'm going to look at, once again, this combination of this slow line and the fast line. This is a stochastic, a 9-period stochastic smoothed by, you can use 14 or 16, doesn't matter. But my 310 moving average oscillator, I'll get the exact same pattern. So here you can see the slow line correcting all the way up as we struggled in this rising channel. And then, of course, since the trend was down, the downtrending channel was so much steeper, and you can kind of get the feel again in the channels with these oscillators. So if you think about your waves up during the day and your waves down during the day, think about them as being compound waves, having ABC or ABCDE. So usually in a swing up, we'll usually get one, maybe 2 dips in the oscillator to trade in the direction of that wave if I were being very aggressive and trading against the trend there, which I probably wouldn't advise in this particular case because we had just broken down from this. Or here you can see I've got pretty clean downtrending channel, and it usually tends to bounce back and forth in 3 or 4 little sublet waves. Now lastly, on this chart, this is actually a 1, 2, 3, 4, 5, 6, 7, 8. It looks like it's an hourly chart. You know, a lot of times I get these questions, well, what time frame do you use? You know, what blah, 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 blah. And of course, you know, I think most traders use multiple time frames, you know, the 5, the 15, the hourly, you know, throw in a couple tick charts there, etc., etc. What you will notice, though, is that for your main roadmap, it needs to be that higher time frame. And the reason is the further out that you go on your time frame, the less noise there is and the cleaner the oscillator patterns will be. So it'll probably be much easier for you to see the waves and the swings and the cycles and whether the oscillator is turning up or down and get a feel for the rhythm, if you will. It'll be much easier to do that on a 60-minute chart or even a 120-minute chart than it is if you're looking at 1-minute charts or even too low of a tick chart. You know, you'll get a lot of noise, which means your oscillator is harder to read and it whips around a lot more, and it's a less reliable roadmap to get the main idea. So I always love looking at the 60 and the 120-minute charts. So just quickly to summarize, we talked about having 3 data points to define a trend. Now here you can see on this chart we only have 1, 2 swing lows, so we don't have any chance of a trend reversal yet here on this first channel that I've got drawn. It's a corrective channel still leading to another down leg. We really need those 1, 2, 3 lows here before we can really start to be looking for a trend reversal, in which case you have to take out that swing high like we did today. Summarize so far, you want to come in a Opening price, previous day's highs and lows. How are we trading around that previous high and low on early tests? How are we trading off the opening price? Is there an increase in volume in that first 30 minutes? Is there an unusual drive indicating an extreme supply-demand imbalance, which is much more likely if we have a large gap up? You can have a large gap up and trend down, or a large gap up and trend higher, as was the case today. Gaps lead to greater movement. And then the next thing, if we look at our chart points, swing lows, 2 lows define support, not 1 low, 2 lows define support. You need to have 2 higher lows before you can start looking for your trend reversal. If you get 2 higher lows, you can put a buy stop right above that previous high and have a pretty good entry for a potential breakout trade. On the counter trend trades, you're much better to sit there and look for scaling out as opposed to trailing a stop. Really only on the breakout trades do we want to trail a stop. Our goal is to trail a stop and stay with that until you see some type of non-confirmation on the top of that upswing. And non-confirmation will show up with an oscillator making a divergence, a momentum divergence, or perhaps a test where the S&Ps make a higher high and the Russell and the Dow make a lower high, or so forth. And you can play the same thing if you're a trader in the semiconductor shares or stocks, looking for the confirmation and the non-confirmation on the relative strength leaders and laggers. Oscillators are a great tool. They're there to highlight what's in the chart, though, first. So I want you to get the time of day concepts, these main pivots first. Then I want you to think about the chart structure, ABC waves, tests of highs and lows. And lastly, only lastly, do you start throwing up your indicators like momentum oscillators or RSI or CCI, or pick your poison. It really doesn't matter. Just pick one tool and specialize it. So with that, now we're going to go and we're going to look at some unique things with today's action. And I'm going to ask my technical support guy here to come over and help change some charts so we can go live. And here's today's action in a candlestick chart, and this is a 3200 tick chart. So the nice thing about the tick charts is I use them when I come in the morning session and I want the continuous data. It's kind of bogus for me to look at a 15-minute bar chart on a 24-hour session because there wasn't the volume there. And of course, it just doesn't have the same movement and same feel. But if I look at a tick chart, it's going to be so much more fluid and symmetrical, and the patterns and so forth. So with that said, it looks to me like we actually opened up this morning. I think we were opening up right in this range here because we blasted up off the number there too. So we had a little bit of initial trading around here. We already did our trend reversal yesterday. We know that we're in an uptrend from that trend reversal yesterday. And this huge bar up here, we had very strong volume in the first 30 minutes. So that immediately tells me, of course, with the breadth and so forth, and the breakout from that 6-day range, you've got pretty good odds of a trend day up. With that said, a trend day up may only have one ABC type of correction. By that, I mean one spot where you pull back below a previous swing low. It rarely trades back to the 15-minute EMA moving average. Although we did today in all the indices except the Russell, I believe it failed to pull back to its 15-minute moving average. But usually you will not pull back to that point on a trend day. We will see it the next day. So here you can see we pretty much had a pattern of higher lows all the way up until we had that kind of little which I don't think the Russell did. Correct me if I'm wrong here, but only the S&P gave a little dip there, and of course the really strong close with the increase in volume in the last hour. So as a day trader here, there was not a whole lot of opportunity once you got marked up to this level. Now, the reason we spent so much time on this level was, this is live, I can put up an hourly chart, right?
Yes.
Can you make it an hourly day session chart?
Today, 1
Okay,
hour.
yeah, we just want an hourly chart. Okay, and squish it up, and I don't know if you can take out the night session or not. Zoom in, zoom out. You know, if you can't do that, we can just put up a day session. There, yeah, okay, just make it a day session here.
What do you
Okay,
What do you want to see?
daily. Let's just look at dailies here.
1 month day?
Sure.
That's going to show you 1 bar for the day.
That's fine. Okay. All right. And I think I get the hang of this real quickly here, huh? How about that? I can click on the mouse too. So anyway, my point is, look at this swing high right here. This swing high came in at 80.25. Now, right away, if you're a day trader and we're breaking out like this, you should be looking. Where are those previous swing highs and those previous swing lows? Because we are going to test those. Those are magnets. So first, we finally did make it up to this area here at the end of the day. And also, look at this huge trading range here. Back in market profile concepts and terminology, it's a value area, a trading range. Now, it doesn't matter if you're looking at 1-minute charts or 5-minute charts. Take horizontal lines and picture the middle of those trading ranges. That's a value area where the price traded multiple times around those areas. And here's a simple rule of thumb with trading ranges. You're either moving out of them to the next range and you're doing it on increasing volume, or if you push outside a trading range and there's not the volume and you see those non-confirmations, where are you going to go? You're going to go back to the middle of that range. So that's a real crude little model for you to think about. If you make a counter trend trade, where do we want to cover our scalp trade when it gets back into the middle of that trading range somewhere? That's just real crude, okay? I want you to start thinking in terms of these concepts instead of just 5-minute bar charts and oscillators. So important. So we rallied back up into the middle of this whole range here, and we had a strong close, so we'll probably trade a little bit higher up tomorrow. And also you can see it was a breakout from these 6 bars here. A 6-bar coil is pretty significant, so we'll definitely get some continuation to the upside out of this pattern. But we used up a lot of bullets today, so my initial thinking would be at the end of the day as a trader, I'm going to think, okay, let's see if we can rally above today's high, maybe up to what do we have here in this range? This 88 area would just be a good level that I'd kind of have in the back of my head. You know, it was a swing high. It was a close here on an up close. I'm thinking 88. If we were able to push up in the morning to 88, you know, today was a day where it traded low to high. Tomorrow we might have 2 or 3 swings in both directions so we could play. If we rallied up strongly in the morning, I'd look for a correction back down. I'd look for a short trade with some type of test up there. Perhaps retrade back to the 15-minute EMA or back down to a level. We could pull back down as low as this 74 area, 76 area today, because right below that was the markup period up to that 70, 72, what we call single prints, that huge push-up impulse move, if you will, all right? So we could pull back as far as 74, somewhere around there. And then I would definitely look for a morning dip, depending on how high we rallied up, you know, pull back of 8 points. I would definitely be a buyer and looking for some resumption of the trend. It may not happen that way at all, but the point that I want to make is that I've already got a model in my head. So if I'm thinking as a day trader, I've already got a model, and it is far better to have the wrong model than no model at all. I got to repeat that to you. If you have some idea as to what the markets might do, or you're looking at, the hourly oscillators, or I'll mention one more book to you in a minute. If you have some idea as to way the market might trade, that is far better than not having any idea at all. And the reason is because if you're right and it's doing what you're thinking it should do, you'll have all the confidence in the world. If it's not doing what you thought it would do, you'll know it right away. Trust me, if you think the markets should go up and it's selling off sharply, you'll know it right away. And, it's better to know that you got the wrong model, because that in and of itself gives you some directional type of play. Now, two things. When I was first on the trading floor, my original mentor, back in the good old days, would sit there on his little trading card, and every day he would do exactly that. He would sketch out what he thought the pattern for the next day should be. So, for example, let's say the market had already rallied low to high 2 days in a row. Well, he would draw a little squiggle that then had an arrow with a downturn, looking for some profit taking or some short selling to come in and have a push down. So if you test yourself, and at the end of every day, you sit there and you kind of draw, just look at the 15-minute oscillator, look at the 60-minute oscillator, just think, have we had 2 to 3 days low to high? Did we just already have a rotation day with a lot of consolidation, in which case we've got better odds of a trend day? Write out your little thing every day at the end of the day, and you will see over time, I bet you can get to about 66% accuracy if you practice that little trick. Takes 2 seconds. It's a good exercise for you to do. With that said, also, there's a wonderful book, which I'm not going to recommend for its reading value because the author stinks, and he's dead now anyway. But that was Taylor, George Douglas Taylor. I'm actually going to do a 3-hour workshop at this in the Las Vegas Expo if you guys want to come by on this Taylor trading technique, which has been so integral to my S&P trading, because if I sit there and I can say, okay, today should be a buy day, or today should be a sell short day, that should be my bias for the day, and how I come up with that, it's really going to emphasize to you the importance of thinking, has the market been low to high 2 to 3 days in a row? Have we just had a correction back down? If we're in a downtrending market, you might only get 1 day that goes from low to high before setting up your sell short day. And in the strongest uptrends, let's say we've had 5 days in a row that go from low to high, and we're in an uptrend, and you get 1 day that goes from high to low. The next day is a very strong buying day. So these are the types of things that you can keep in mind for a conceptual framework as well. And you can see you can go crazy looking for little divergences on the oscillators, on 5-minute charts. The more confirmation you get between looking at the indices, if they all show the same pattern, it's going to work much better for you. So I have a chart page that has 5, 15, and 60-minute setup for each of the S&Ps, the Russell, the Dow, and the NASDAQ. And if I see all 4 of those indices looking exactly the same pattern on a 5 or a 15-minute oscillator, I'm going to be all over that thing because it greatly enhances my confidence level. So how are we doing here time-wise? Because I want to have some, there was a question on the book, the George Douglas Taylor book, and that is called, believe it or not, The Taylor Trading Technique. That was written by George Douglas Taylor. I know that you can order it from Traders Press for a pittance. It's not one of those gnarly $100 books. It was actually written in 1950, and he was a wheat trader who applied this methodology to stocks and a multitude of markets, and it just works particularly well with the S&Ps. And the other book, what's the name of Jim Dalton's book?
Mind Over Markets?
Mind Over Markets. That's the name of the Jim Dalton book. See, anytime you listen to me talk, I'm going to give you enough homework, to last you the next next couple weeks until I can speak again, I wanted to emphasize a couple things to you today, and that is, first off, there is plenty of opportunity from the New York opening to the close in our session. There is still plenty of range, even though it may appear like a lot of the action happens overnight. The amount of the day's range that occurs in the first hour is about 60% higher than it used to be 15 years ago. So, for example, on a trend day like we had today, it used to be that the first hour's range would account for 40% of the day's range. Nowadays, that number is more like 65%. So, there is a much greater urgency off the opening price. There is a much stronger propensity for this staying with a VWAP and dogpile, much greater dogpiles than we ever used to see. So a lot of the move can occur on a trend day in the first hour, hour and a half of trading, in which case it takes a long time to consolidate that move, as was the case today. The second thing is that there still is plenty of opportunity on normal trading days. Just think about having, a swing, a morning swing to play for and an afternoon swing to play for. Just keep it down to those levels. Be particularly conscientious about this 2 times. The push into the Europe close, which actually can happen about 15 minutes earlier. That's like 11:15 Eastern Standard Time, and then we also get often a residual kick of the trend into that 12 o'clock Eastern Standard Time. In the good old days when there actually were specialists, then they'd all take off and go eat lunch in shifts, or the Fidelity boys, the mutual fund players, they got their morning buy programs done, and bingo, they're out of there for lunch eating their clam chowder up in Boston. So that would be a very strong time of day tendency. Then you get about an hour and a half dead zone until they finally come back from lunch, and of course after 2 o'clock Eastern Standard Time we usually get a resumption of the movement. Today was a little bit later. The biggest ranges, believe it or not, don't just happen in the morning session, but we look at the ranges for the 5-minute bars, and it really does pick up a lot in that last hour, as well as the highest tick readings, the most extreme tick readings to the upside and the downside occur in the last hour and a half. So don't give up on the day if it appears to be dead for so long. Be mindful of the chart structure, the ABC, 2 points for support, 1, 2, 3 points before you can have a trend reversal. That sets up a breakout play. Just simply put the buy stop above a corrective ABC up. And, always paper trade these things first so that you get a feel for it. Or go back and study chart examples and see, okay, I can see an example of this. You'll see it on zillions of markets, zillions of time frames. If we do have exceptionally strong volume in that first 30 minutes by looking at the New York Stock Exchange volume, if you're trading stocks, I always like to look for which stocks are up the most off that first opening price in that first 30 minutes. So which stocks have traveled the most in that first 30 minutes as a percent-wise? Those are your relative strength leaders. Those are the ones I want to continue to hammer away at to the long side. And same thing, if we're in a strong increase in volume market environment and it's a down market, I'm looking for the ones which have been the weakest off their opening price. I'm going to look for the little 15-minute bear flag intraday, and those are going to be my best short trades, which I can make in the middle of the day. So that's the best day trade I can make on a stock for you. And hopefully Tom will be so gracious as to have me back again so that I can show you some of this stuff on stocks and some really cool tricks there, especially that you can take advantage with options. I have got a list of the 40 top optionable stocks, and I love doing this game on the deep liquid option stocks. You might only make 3/8 of a point on an option or a half a point on an option, but for a nice little day trade, but it really does add up, and what we're looking for is consistency with that game. I know I've I've given you the most important things that I think are there. I don't think you need any more books on this stuff. Just your common sense and writing stuff down and printing off chart examples. Do read that market profile book, because you get a good indication of the types of days that can unfold. And I'm going to take some time here and answer questions, because you can go to my website, lbrgroup.com, and we have all kinds of lectures and articles and stuff on there that you can read. But I'm here for you now. So let's get some questions here. Do I sell out of the money options? This isn't an options. I don't sell out of the money options, period. I did sell out of the money options once. In 1982, I sold straddles on a stock called City Service in 1982, and it took me 5 years to pay that off after there was a takeover bid. So I don't want those outliers. I am a firm advocate of Talib's Black Swan. Okay, let's see here. Okay, we took care of those out of the money options right away. Trading the Russell. The Russell is really interesting because it has slightly different time of day functions. The really important thing about the Russell is that because it's the small caps, it's going to be most highly correlated with the market breadth. So if you see that Russell leading, that is a really powerful indicator that that market's going to continue in the direction of the Russell, because it represents the broad market. So I have a lot of confidence buying S&Ps or dips in the Dow or anything like that if that Russell's strong. And the best indicator, which I like even better than the VIX, is the RVX. That is the implied volatility on the Russell options, and that is less noise than the actual VIX. So that's a really cool little thing. With the TVOL, then the volume, hey, can you create a 30-minute chart of that for me? And we'll just take a look at that right now. Look at some of these things. NASDAQ minis are a great thing to trade too. They will be particularly sensitive if the internet stocks, which were so strong today, eBay and Amazon and so forth, are working well, or the semiconductors. So they have their own little personality too. The best indicator to use for avoiding whipsaws. Can you squish that up at all and show any more days volume? Or more days on there? Can you show like 4 or 5 days on there? So the best indicator, I'll tell you, for avoiding whipsaws is very often volume. On a lighter volume day, hey, this is cool. On a now, how can I get a, okay, there we go, a little horizontal chart there. On a lighter volume day, you're much more likely to have whipsaws. Just keep that in mind. Now here, I put up exactly what I was talking about. Dollar TVOL, volume, New York Stock Exchange volume works as well as anything despite all these black pools out there and all this nonsense. So check it out. Check it out. Look at Thursday, ridiculously light volume. Friday, ridiculously light volume. Monday, even lighter volume. And what did we have? We had whippy markets that couldn't have any follow through, even though they did spike up tests and spike down tests. You can't have a sustainable rally or a sustainable sell-off unless you see that increase in volume. Now, check out today's first 30-minute. You see right here, this bar right here? Bingo! Extreme volume, better than the previous 30 minutes. If I see that, that is going to continue. I know that we're going to have heavy volume all day long, and that leads to movement. Takes the higher time frame player, the institutions and so forth, to mark price up to a new level. That means pushing it outside of the trading ranges. And that's what we had today, this huge, ridiculous, steady increase in volume. So that was really strong confirmation of today's breakout, which means tomorrow, be on the alert for any pullback on this 15-minute oscillator or this 30-minute oscillator, a flag or an ABC type of continuation pattern. You're going to still go higher because of this. Okay. Let's see here. can we put up like a 15-minute chart? Maybe we'll just take a good look at that today. You know, I don't know, I'm not as familiar with the Thinkorswim platform in terms of being able to draw lines. I know a lot of traders, before they come in the morning, will just simply put resting horizontal trend lines on their chart, and I'll bet you 10 to 1 because I know that this platform has a scripting language. I know you can do it with programs like CQG or TradeStation or that type of thing. You can actually plot the previous day's high or low, and I'll bet you 10 to 1. These guys are pretty smart here that they can create something that plots a line that shows the previous day's high and low as well. So I'm going to put that number 1 on the list for their guys. These guys are really responsive here. You know, if you want something written, they'll do their best to find that out. Can you make like a 15-minute chart of the Russell, perhaps? Or how about just put the S&P up? A 15-minute chart of the S&P is great. So this actually, you can see this huge drive that we had up this morning in this volume. This is actually pretty unusual that we actually meet that 15-minute moving average. You know, on a day like today where we do have that huge increase in volume, I'm not going to be playing the counter trend game. I'm just going to work the market from one side. And this is another misconception about day trading that people have. You know, they think that you go long, then you go short, you know, and you flip back and forth and so forth. I find that the best day traders I know pretty much are pretty adept at working a market from one side. You know, if it has a slight upside bias, they're not going to short it. They're just waiting for the pullbacks to buy type of thing. And you can do that with anything. But when you work a market with a bias, which of course ideally that bias should be in the direction of the trend, you are going to trade far more efficiently. You'll have better entries and you'll have better exits if you're just concentrating on one game. In fact, to give you a funny example, there was a fellow on the trading floor when I was down there years ago, and his name was Ron Slack, and he would only trade from the short side, and this was through the greatest bull market all through the 80s. He would only trade from the short side. That was his game, and you know what? He made a ton of money because he would pick his spots, you know, for those right spots, use type spots, you know, catch a good flush down. He would pick his spots. So it's very much about being discriminating and picking your spots if you're going to work the market from one side or the other. And of course, ideally, you'll get more bang for your buck if you're picking your spots in the direction of the trend. Okay, we got the Russell up there too. You guys are funny. I'm just sitting here reading all your comments. Crack the whip, no money business. Oh my goodness, you guys are a hoot. Let's just look at the Russell here. It actually did hit the 15-minute EMA, but more often than not, you'll see this pretty common little bull flag type of pattern, and this sucker was the strongest. You know, remember I said the S&Ps did a little ABC back down and pulled below that swing low, and the Russell didn't. So you know, if you were looking for a break below that swing low, you didn't get any confirmation on this Russell. It was pretty strong. This is a pretty boring chart. It's like you showed up at the party, bought, and then you exited at the end of the day. There sure was not a lot of day trading opportunity today. When you see that extreme breadth reading and you're never getting your pullback on the 5-minute charts or your pullback on the oscillators like you wish, there is really only one game that you can do. And this is a dinky scalping game. You're not going to get rich doing it. It might just make you feel like you're doing a little something productive, and that is simply when you have an strong breadth reading. Is there any way you can put up a chart of the ticks, dollar, T-I-C-K, or whatever it is? When you have extremely strong breadth, you can treat the ticks like a 1-minute oscillator. Buy the pullback in them. Immediately put an offer out for 4 to 6 ticks above that, and you've got your scalping game. This here is just a 1-minute chart of the ticks. Oh, this is a 15-minute? Oh, okay. Can you make it a 1 minute here? This is if you happen to have had a particularly good night's sleep and you've had 5 cups of coffee and you're feeling really frisky or energetic. About the most you can do, we had incredibly strong trend in the breadth, which will put up, remember what I said too, the ranges in the ticks tend to increase in the afternoon. So here you see we had this push down in the ticks, these minus 700 reading, a little bit minus 600 reading. If you are in such a strong trend day, you can look at those as buy wholesale, sell retail. So simply buy wholesale when those ticks are down and sell retail when they pop back up. I will only play that game on a strong trend day. Any other day, you don't really want to be making counter trend initiation on the ticks unless you've got that strong trend as your friend. Now, can you put up the, do you know the breadth here, the advanced decline at all? Let's see here. If not, that's okay. Let's just see here.
Sure.
Awful ticks.
They'll probably tell you in there.
Okay. Any other questions here? Let's see. Internals aren't a waste. I can tell you they're not a waste because I made a hell of a living being mindful of those internals. Internals include, of course, volume could be considered to be an internal. The market breadth is definitely a market internal to tell you how many stocks are up and how many stocks are down. But even more important than the actual breadth reading is the trend of the breadth. Because you saw yesterday that breadth was trending down. It was up and then it's trended strongly down and vice versa. You can have breadth that's minus 1,000. That's not bearish if it's going minus 1,000. Now it's minus 600. Now it's plus on the day. That's incredibly bullish. Okay, can we back it up to like yesterday? Can't tell anything here except that it was just extreme breadth. But now you can see the symbol in case you weren't aware of it. Sure, 15 minutes. Yesterday you can see we had some fluctuation in the breadth. This is not a great chart or great example. So I'm going to, what time frame do I trade more often than anything else? Think about the lower time frames as being triggers into your higher time frame. If I'm looking for that hourly oscillator to turn up, I might want to wait till I see a higher low on a tick chart or something like that, or a pullback on a tick chart. So I definitely will use them as initiation. There's absolutely nothing wrong with trading off of a 5-minute bar. You can get some great signals just looking for 5-minute buy divergences or 5-minute pull flags. That's usually good for anywhere to 2 to 5 points at times. So there's there's nothing wrong with that. Let's see here. I'm not familiar with any of these other people, honestly. I don't know some of these names you guys are flashing up here. I kind of do my own thing. Divergences between the advanced decline line and up and down volume. Up and down volume, I'll tell you, I used to love the trend. It was one of my favorite indicators, and that's a ratio of the up-down volume and a ratio of the advanced decline line. I have only one caution now. When you're looking at the trend, it's not as significant as it was a year ago. But you guys remember the days when we had like City, and it was trading like such extreme radical volume. I mean, it was $3, and so it was greatly distorting some of the up volume down ratios or the trend. So just take a glance at the top volume stocks and make sure you don't have like a little $3 stock that has such a disproportionate amount of volume, Citibank, for example, that it was distorting things. That's my only comment there with the volume. These are all just tools. They kind of work hand in glove. Not one thing is going to be the end all and be all, and that's why I emphasized in the very beginning, get the concepts right. Where's the opening price? Where's the previous day's high or low? And is it increase in volume or is it counter trend chop rotation environment? Get your concepts down first. Then you can look at the chart structure. Then we can add the supporting things such as market internals or oscillators or whatever you want to help fine-tune your technical entry. Levels, I think, are the actual swing highs and lows are probably more important than anything. I got a question here about why did bonds fade back up when breadth consistently melted all day? Breadth wasn't melting all day. I mean, every stock was up. You couldn't get much stronger breadth reading. Those were some of the highest breadth readings we had in 2 months. So it's okay if it looks like it's backing off a little bit. You know, if breadth's plus 2,500 and it goes down to plus 2,200, that's not melting down. You know, that's pretty strong in my book. It's really holding up there. I just think that everything gapped up so much. You know, you just really couldn't back off. You know, couldn't increase a whole lot from there. You know, one thing about watching these intermarket correlations, all right, every market still has its own personality. Keep that in mind. And even if you have a market that appears to be 90% correlated or 90% inversely correlated, they still have their own time of day functions. You know, is the Fed doing its open market operations? You know, do you have certain bank desks closing or European bank desks closing and they need to flatten out credit instruments? There's a lot of different factors going on, or something might just get overdone. You know, you could look at where did the bonds trade to today. If you were aware of that pit session gap which they had, which started at 28 and closed the gap at 14, look what happened the minute that those bonds closed that left open gap to the downside 14. Bingo! You don't think everybody was watching that gap close to cover their short positions, which is why they rallied up so sharply. So you got a lot of different factors out there. Shorts covering, longs exiting, blah, 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 that create different waves and dynamics, even though I know that the markets have been extremely highly correlated in the back. Okay, let's see here. You know, gaps, regarding gaps, they're just visible chart points, guys. Look what happened today. You don't think everybody's watching the gaps to the upside. Of course everybody's watching the gaps to the upside. You know, the swing highs, the swing lows, the gaps, the visible chart points, they're like magnets. They rule the market psychology. Man, I would love to do a presentation for you on stocks. You know, I love futures too. So you guys let Tom know and let Damon know, who's now your main futures guy, the markets that you want to trade. You know, you want me to talk on bonds, I'd love to do that. Currencies, gold, silver. You guys tell them what you want and I promise I'll come here and deliver. So with that, I'm going to wrap it up. And again, if you have to send me an email, I don't mind at all, lbrgroup@atnt.com, because I don't want to leave you with any confusion here. And you guys are the best. You're an awesome group of people. Thanks so much, gang.